Imagine for a second holding a golden ticket, a deal so unbelievably, impossibly good that every time you use it, you literally feel like you're getting away with a heist. You pay a tiny, almost laughable flat fee, and in exchange, you are handed the keys to endless premium entertainment. But here is the catch. Every single time you use that ticket, it costs the company providing it double, sometimes triple what you actually paid them. It sounds like an absolute dream scenario for you, the consumer, right? But for the business operating behind the curtain, it's a ticking financial time bomb just waiting to detonate. Welcome to This Explainer. Today, we're diving deep into a dramatic financial paradox that completely shook the entertainment world to its core. We are going to unpack a wild story of blinding ambition, explosive hypergrowth, and one of the most spectacular, jaw-dropping corporate collapses in modern financial history.
To really grasp the sheer, terrifying scale of this business disaster, you have to try and visualize a company burning through an astronomical $40 million, not a year, not a quarter, $40 million every single month. It's hard to even wrap your head around that kind of cash burn, right? They were entirely trapped in a mathematical equation that was fundamentally, objectively impossible to survive. But here is the truly crazy part. Instead of hitting the brakes, instead of fixing the broken math, the executives in charge actually stepped on the gas. They just kept pushing, kept aggressively selling, and kept confidently promising their Wall Street investors that everything was totally fine and under control.
So this brings us to a really fascinating, almost counterintuitive mystery. How does a booming, incredibly hyped service actually drive itself into total, catastrophic collapse, simply by giving its customers exactly what they want? Think about it. Usually, massive user growth, hitting that viral tipping point, that is the ultimate end goal for any startup. It is literally what tech founders dream about at night. But in this specific, bizarre case, extreme popularity became a fatal, incurable disease. To really understand how a business gets to that point of no return, we have to rewind the clock and start at the very beginning, long before the financial madness set in.
Section 1. The $10 ticket.
Let's go back to 2011. Back then, MoviePass was actually a quiet, fairly modest startup. It was created by two founders, Stacy Spikes and HMNY. In their original business model, it actually made sense. They were charging hardcore, dedicated movie fans a reasonable $30 to $50 a month. But everything, and I mean everything, shifted dramatically in 2017. An analytics firm called HMNY swept in, acquired a majority stake in the company, completely pushed out the original visionary founders, and installed a new CEO named Mitch Lowe. And then, they made a pricing decision that absolutely shocked the entire theater industry. They dropped the monthly subscription price to an unbelievable $9.95. For less than a $10 bill, you could walk into a theater and see one standard movie every single day of the month.
Now, as you can probably guess, that single pricing decision triggered explosive, unprecedented growth. I mean, let's look at the reality of the market at the time. With average movie tickets already costing well over $9, offering unlimited movies for under $10 basically meant MoviePass was standing on the corner, handing out free money. The word spread like absolute wildfire. It was water cooler talk everywhere. Because of this, the user base skyrocketed from a quiet 20,000 subscribers to a staggering 3 million paying users in less than a year.
Section 2. Mathematically guaranteed to fail. On the surface, if you just looked at the user acquisition charts, 3 million subscribers looked like the ultimate tech success story. But beneath the surface, they were dealing with a massive, fatal flaw: negative unit economics. See, management was relying heavily on what we call the gym membership model. Gyms only survive because millions of people pay the monthly fee out of guilt, but they rarely actually show up to use the treadmills. MoviePass executives were praying, literally betting the entire company, that their users would do the exact same thing. But a movie ticket isn't a grueling workout. It's a high-value, highly desirable, zero-friction entertainment event. Once people fully realized they could extract hundreds of dollars in real-world value for just $10, they absolutely flooded the local theaters. The company had essentially engineered a perfectly fatal trap for themselves. Think about how the money actually flowed here. They collected a flat $10 a month from you. But because they had no special deals in place, they had to turn around and pay the theater's full retail price for every single ticket you bought. For example, they were paying an average of $12.02 to AMC theaters for just a single showing. The math is brutal. If you went to see just one single movie a month, MoviePass lost money on you. If you went to see two, they were financially bleeding out.
The internal data paints a picture of just how doomed this entire operation really was. To simply break even, not make a profit,
just survive. MoviePass desperately needed their users to see an average of 0.77 movies per month. But that incredible viral $10 price tag naturally attracted massive power users. By June of 2018, the actual user average was 2.11 movies per month. That is almost 3 times higher than their absolute maximum survival rate. This meant that every single time a new user excitedly signed up for the app, they were actively destroying the company's bank account, mathematically guaranteeing catastrophic daily losses.
Section 3. Growth at any cost. So, what was the grand master plan? The executives firmly believed that if they just got big enough, if they captured enough market share, they could ultimately force the massive theater chains to bend to their will. But the cash burn required to reach that point was just terrifying. Between late 2017 and mid-2018, they were hemorrhaging an average of $21.7 million a month. By May, that cash deficit hit $40 million. And then it was projected to hit an unthinkable $45 million by June. Now, to fund this staggering, endless loss, the parent company, HMNY, essentially turned on the money printers. They endlessly printed and issued new shares of stock to the public. By doing this, they diluted the value of their existing shareholders' equity by an astonishing 99.9%, all just to keep the server lights on for a few more weeks.
You might be wondering, how on earth did they justify this absolute carnage to Wall Street? Well, they confidently told their investors that massive alternative revenue streams were right around the corner to bridge the gap. They claimed, with total certainty, that they would sell valuable subscriber location data to targeted advertisers. They even started a venture arm to co-finance theatrical movies, like the John Travolta mob film Gotti, which, unfortunately for them, ended up bombing at the box office and losing millions more. They also loudly demanded a cut of concession sales and revenue sharing from the big theaters. But here is the cold, hard truth of the matter. They had aggressively priced their core service at $10 without actually securing a single one of these lucrative back-end contracts first. It was all a complete mirage.
Section 4. Desperate measures and tripwires.
As the capital markets completely dried up and the company's stock price crashed violently towards zero, absolute panic set in at headquarters. And this is where things get genuinely wild. The company launched a covert, completely hostile war against its own paying subscribers. Management quietly deployed deceptive internal mechanisms they called tripwires. Basically, if the company's daily funds ran dangerously low, an automatic shutdown mechanism would trigger and just freeze the app for everyone. Even darker than that, former employees later revealed that leadership actively targeted and locked out their most loyal power users. They were intentionally going in and changing user passwords just to physically prevent them from logging in and buying tickets to massive, expensive blockbusters like Avengers: Infinity War.
The ultimate breaking point finally hit in late July of 2018. It was pure chaos. The company literally, physically ran out of money to pay its payment processors, and the entire app just went completely dark. Users were stranded at the theaters. Management had to desperately beg for a $6.2 million emergency high-interest loan from a hedge fund just to turn the servers back on the next day. And what did they do the minute the app came back online? They immediately blocked all users from seeing the new release, Mission Impossible Fallout. Then, to try and artificially save their stock from being completely delisted from the exchange, they executed a frantic 250-for-1 reverse stock split. This incredibly rapid sequence of hostile, desperate changes completely destroyed whatever consumer trust was left in mere days, wiping out 99.6% of all remaining investor value almost instantly.
Section 5. The House of Cards collapses.
Those chaotic app outages and blocked blockbuster movies, those were really just the visible cracks on the surface. Behind closed doors, the entire corporate foundation was giving way to intense, highly serious federal scrutiny. Expert financial analysts stepped in and meticulously documented the massive scale of the deception for securities litigation. The devastating, undeniable truth was eventually laid bare to the SEC and the Department of Justice. The executives allegedly knew all along that the unlimited $10 plan was a mathematically impossible pipe dream. The authorities claimed they were essentially using this completely unsustainable model as a temporary, flashy marketing gimmick to artificially inflate their stock price and knowingly deceive everyday retail investors.
The final aftermath of this entire saga was absolute, unmitigated financial devastation. The MoviePass service was permanently suspended, pulled entirely offline in September 2019. The parent company, HMNY, officially filed for Chapter 7 bankruptcy, which means it wasn't a restructuring, it was a total, complete liquidation of all assets. An estimated $303 million in investor capital simply vanished into thin air, entirely wiped out. Ultimately, the consequences caught up with the leadership. Both Mitch Lowe and HMNY executive Ted Farnsworth faced serious federal criminal charges, and both ultimately pleaded guilty to securities fraud. The wild, debt-fueled ride officially ended, not in a boardroom, but in a federal court.
Section 6. Rising from the Ashes. But incredibly, the story doesn't actually end with bankruptcy filings and prison sentences. In a twist that feels like it was pulled straight out of a Hollywood screenplay, the original ousted founder, Stacy Spikes, the guy who had to sit on the sidelines and watch the company he built completely crash and burn, stepped back into the picture. He went to a bankruptcy court auction in 2021, and in an amazing moment of poetic justice, he repurchased his stolen brand for just $140,000. To really put that number into perspective for you, this was a company that, at the peak of its absolute mania, was valued at over $500 million, and he bought the whole thing back for absolute pennies.
But Spikes didn't just buy the name back for nostalgia. He came back to actually fix the underlying math. He took a hard look at the business and completely eliminated that toxic, radioactive, unlimited tier. It was gone. Instead, he designed and implemented a smart, variable dynamic credit system based heavily on the actual laws of supply and demand. Think about it like this. If you want to see a massive Marvel blockbuster on opening night in a major city like New York, it costs you more credits. But if you want to catch a quiet indie film on a Tuesday afternoon, it costs you far fewer credits. By finally respecting the basic, undeniable laws of unit economics, the newly relaunched MoviePass actually achieved its first ever fully profitable year in 2023.
Stacy Spikes was once quoted as saying, "I have this obsession with making moviegoing as easy as they make Instagram." And honestly, that single quote perfectly captures the core of this entire journey. It proves that a genuine, foundational love for cinema, when it's actually paired with logical, sustainable business practices, is powerful enough to survive even massive corporate sabotage, greed, and widespread federal fraud. The underlying idea was always good, it just needed the right math behind it.
So as we wrap up this explainer, we really have to ask ourselves a crucial question looking forward. Will the massive entertainment industry ever attempt a deal this spectacularly wild again? Or has the explosive rise and catastrophic fall of the $10 ticket permanently changed how we as a society value our movies? The next time you eagerly sign up for an unlimited, all-you-can-eat subscription service that feels just a little too good to be true, ask yourself, who is actually paying the final price? Thank you so much for exploring this unbelievable financial thriller with me today. Keep asking those hard questions and always, always keep looking at the math.